What's up, guys? Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers, so please be careful. Don't get yourself scammed. If you want up to 12 free stocks, Weeble is going to give you up to 12 free stocks when you open a new Weeble brokerage account. Put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out their brokerage app. There's a link down in the description box of this video. Go click on that Weeble link. Open up your new Weeble account today. Go get that free stock. Go get that free money. I'm going to also send you a Weeble tutorial video to walk you through how to use the Weeble app to make your first trade. All you got to do is send me an email. Let me know you've opened your Weeble account. Let me know you funded that Weeble account. And I'm going to send you that free tutorial video. My email address is down in the description box as well. Can you guys say soft landing? That's right. The Federal Reserve had its last meeting of the year today. And in that meeting, they've made it clear they're not going to raise short-term interest rates anymore. And the reason they're not going to raise short-term rates anymore is because the economy is doing well. Inflation is coming down. They haven't increased short-term interest rates in 5 months. And the world didn't end. So the Fed has basically stated, now they didn't come out and say they weren't going to raise interest rates no more. But if you listen to the Fed Chair Jerome Powell when he spoke at 2:30 Eastern time today, and you kind of listen to him, he basically said that they're done rate hiking. And that's good news. That's good news for investors. It's good news because when interest rates are going up, the stock market's going down. When interest rates come down, the stock market is going up. And I believe in 2024, the Fed will start reducing short-term interest rates. And the market believes that as well. Now, some folks believe it'll happen in March of 2024. And then there are other people who believe it will happen around May or June of 2024. I'm one of the people that believe interest rates will start coming down in May or June of 2024. And when that happens, our stock market will start trending upward faster. Right now, we're just having a bear market rally. Let's call it that. But I think eventually, when the Fed start reducing short-term interest rates, that will spur a new bull market. No expert here, guys. I'm just giving you my opinion. Now, I watched the Fed chair today and listened to what he had to say very carefully. The rate hikes that they've done over the last 20 plus months have worked. And guess what? The economy is still doing fine. That's the soft landing that they were looking for, that they've been talking about for the last 20 months. We want to bring inflation down, but we do not want to throw the economy into a recession. That is what they wanted all along, and that's what the Fed got. They got a soft landing. Brought inflation down, but kept the economy relatively healthy. And how did they do that? Well, they got a little bit of help. See, the jobs market or the labor market helped them. If the labor market would have collapsed while the Fed was increasing short-term interest rates, then in my opinion, that would have thrown us into a recession. Why? Because when people are fearful that they're not going to have a job, they stop spending. And if they stop spending, our economy is in trouble. Why? Because our economy is fueled by consumer spending. And if people are afraid they're going to lose their job or they're afraid they're not going to get wage increases, people stop spending. And when they stop spending, that means companies ain't selling products and services. If companies are not selling products and services, our economy stops. It stops growing. And the labor market prevented that, even though interest rates were being jacked up to 5.5%. Guess what? Our labor market was resilient. So even though the Fed wanted to cool off the labor market so that inflation could come down, they didn't want to stop the labor market completely. Guess what, though? The Fed did cool off the labor market. Think about January of 2023. We were adding 400,000 new jobs a month. That was too red hot. Inflation would not be able to come down if that pace would have stayed there. Guess what happened, though? Fed kept jacking rates. Guess what happened to the labor market? It cooled off, right? In October, it only added 150,000 new jobs. In November, it added 199,000 new jobs, but 47,000 of those new jobs were not new jobs. They were dormant jobs. Remember, United Auto Workers, to the tune of about 30,000 workers, went on strike. Also, 17,000 workers in Hollywood, went on strike. So those 47,000 workers came back on payroll in November. That's how you get to the 199. If you take those out, because really, technically, in my opinion, they were existing jobs. They just had no payroll attached to them. When the payroll was turned back on, they added them back to the economy. That got us up to the 199. But like I said, if you take the 47 out, we're basically 150,000 new jobs added in November and October, which is exactly what the Fed wanted. Why? Because they cooled off the labor market because of increasing interest rates, but they didn't shut it down. And that's the soft landing that the Federal Reserve was looking for. And that's what they got, guys. So now the Fed chair can come on and tell us basically they're not increasing short-term interest rates anymore. Now, he didn't come out and say that verbatim, but I'm telling you, that's basically what he was saying. They haven't raised rates in 5 months. So you tell me, you think they're raising anymore? No, they haven't raised in 5 months, and guess what inflation is doing? Still coming down. Headline inflation for November was 3.1%. In October, it was 3.2%, slightly down year over year. Core inflation was 4% in November. It was 4% in October. So no increase year over year, just stayed steady. All while the Fed hasn't reduced short-term interest rates. Also, the Fed hadn't increased short-term interest rates. It just did nothing for 5 months. And inflation still came down. It didn't increase itself, is what I'm saying. And so I think the Fed's work is done. Rate hikes are done. Now, investors are trying to figure out, okay, we know rate hikes are done because you haven't raised them in 5 months. When are you going to start reducing them? Because that's what we really want. Now, here's the deal with investors. They know the writing is on the wall. When short-term interest rates start coming down, guys, guess what's going to happen? Money market rates, U.S. Treasury bonds, interest rates start going down. See, here's the deal. When you can get a 5% guaranteed return on your money as an investor, and you have to choose between a 5% guaranteed rate of return in a treasury bond or a money market, or you go into this volatile stock market, a lot of investors elected to take their money out of the stock market and put it in that guaranteed money. But see, here's the deal. You're not going to have that guaranteed money any longer, that guaranteed interest rate. Because when short-term interest rates start going down next year, those money market rates and those U.S. Treasury bond rates, they're going down too. So what's going to happen is those investors who are getting that nice little 5% return, they're going to be forced to come back to where? The stock market, because that's the only place they're going to be able to make money. You got $5.7 trillion, guys, sitting on the sideline right now in money market and bank accounts. $5.7 trillion. I guarantee you when the Fed start reducing short-term interest rates and those money market interest rates go down, that $5.7 trillion will have to come back to the market. And that's where the market's going to boom. And that's what I'm waiting on. So guys, drop me some comments and let me know what you think about the Fed's decision today to not raise short-term interest rates. Do you believe interest rates will be reduced next year, 2024? Love to know your thoughts on that. If you want them 12 free stocks from Weeble, click on that link down in the description box. Open up that new Weeble account today. Go get that free stock. Go get that free money. If you're stopping by the channel for the first time, please consider subscribing, share the video, smash the like button. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. I'm going to catch you on the next video. Peace. Today's video is sponsored by my company, RF Financial Consulting. And in my company, I work with individuals just like you through financial mentoring and coaching sessions. And in those 1-hour sessions, we talk about strategies to help you get to your financial freedom, whether it be through real estate investing, stock market investing, creating additional streams of income, credit card arbitrage, or starting and growing a business. If that's something that you might be interested in, there's an email address in the description box of the video. Send me an email and let's discuss if I'm the right fit for you.